All right, everyone. So this is part 4 of revenue recognition. And so we're going to be covering at least step 4, maybe step 5. We'll see how far we get. There should be, I think, 2 more lectures, actually. We'll do part 4, and then part 5 is going to cover long-term construction contracts. But I'm kind of keeping track to make sure this doesn't go much over half an hour. But anyway, so we're talking about step 4, which is now how do we allocate the transaction price to performance obligations. In some cases, it's very, very simple. But again, this is about special issues that we might have. And so as we walk through it, sorry, let's get that. So again, situation where there are multiple deliverables or multiple performance obligations, long-term contracts, construction contracts, sales agreements that include service, or even like fast food chains. If you go to Chick-fil-A or whatever, and you order a combo meal, you have the sandwich, the fries, the drink, and usually the price that you get is not equal to just the summation of the 3 other prices. And so any kind of situation like that can get a little bit complicated in that, especially if there's a timing difference, or if you track revenue by a specific item, you need to make sure you allocate things correctly. US GAAP strongly urges firms to develop standalone prices for each obligation. So even if you bundle them and then there's a discount, the preference would be that there's a specific, information about, okay, in the discounted sales price, this much is allocated according to the contract to this, and this is allocated to this. That could be specified. Or if you just have standalone pricing for everything, I'm going to show you a method actually using, it's an adjusted market method, which we'll talk about. It's the same method. So if you have standalone pricing, either the contract can specify how much of the discounted price is allocated, or if you have standalone pricing, you can allocate it using a proportional method that I'm going to show you here in a little bit. But regardless of all of that, sometimes there may not be standalone pricing, even though it's desired under US GAAP. So if it's not available, basically there are 3 alternatives. The first alternative is called the adjusted market assessment approach. So in other words, you may be able to look at other market transactions to price every component of the sales agreement. So in other words, I may have some other transaction where I can say, okay, now for every single one of these items, I have other transactions I can point to say exactly how much value or how much each one is worth on its own. So essentially what you're doing is you're developing an estimate of the standalone price in that particular case. And so if you actually have standalone pricing, this is the same method that we use. And I'm going to talk about that a little bit. Another approach would be the expected cost plus a margin approach. So a lot of times whenever you have a contract, you can forecast the cost to satisfy each performance obligation, but you may not really have market pricing for each one. So you just know the cost, but you don't really price everything individually. You've never really done that. And so if you don't have really reliable ways to estimate each individual obligation, what you can do is this cost plus a margin approach. So essentially the first one is a situation where I have a reliable estimate or standalone pricing for all items. And then the second one is a situation where I have no market information, no fair value information, no standalone pricing, nothing. The only thing I really know is the cost or my estimated cost. And then finally, the residual approach is where you can reliably price some of the obligations, but not all, or you have standalone pricing for some, but not all. And so in that particular case, you would allocate the residual to any unpriced item. So you may have, let's say I have 2 items or 3 items, and I can reliably estimate 2, but not the third, or I have standalone pricing for 2, but not the third. In that case, what you'll end up doing is this residual value approach. And again, we'll illustrate that. Okay, so again, you're really, in each one of these cases, you're really thinking about relative value. So whether it's standalone pricing or whether it's a fair value assessment of the price, you're trying to figure out the relative value of each item, and then you allocate according to that relative value. All right, so let's kind of walk through an example. They sell a piece of equipment for $450,000 on January 1st. The sale includes 1 year of seller-provided maintenance. The firm estimates that the market value of the equipment absent the service is $438,000, and that the market value of the service absent the equipment is $30,000. Finally, cost of the equipment was $355,000, and the estimated cost of service is $20,000. Provide journal entries assuming, and the first assumption is that the market price of the service, the $30,000, is significantly more reliable than the market price of the equipment. And so this is a situation where it seems like we sort of have one very reliable fair value, but we do not have both. And so when we have that situation, what approach should we use? So again, this situation where we have one that's significantly more reliable than the other. So of the three, remember the adjusted market approach, the cost plus margin approach, or the residual value. And again, in class, I'm probably going to ask, but the answer is the residual value approach. And so with the residual value approach, if you recall, you assign the fair value of the reliable item or reliable items to that item. And then anything left over gets allocated to the other. It'd be similar if I have standalone pricing. Let's say I have standalone pricing for the service, which you probably do. You could also use the residual value approach for that. So whether it's standalone pricing or have a reliable estimate for one but not all, you use the residual value approach. And so the cash, of course, that doesn't change. We received $450,000 cash. That's fairly straightforward. We're able to reliably estimate the service. But remember, the service is not immediately recognized as revenue because I need to actually perform the service. And so whether we do monthly adjusting entries, quarterly adjusting entries, yearly adjusting entries, whatever it is, I cannot recognize that revenue until I actually transfer the service. Again, we said this terminology over and over again. In this example, we're only going to do an adjusting entry at the end of the year, but whenever you were doing the adjusting entries, if it was every month or whatever, you could recognize a portion of that deferred revenue, but only as you actually provide the service. But again, in this case, we can reliably estimate the service. And so anything absent that gets allocated to the sale of the equipment, which would be our sales revenue. And then, of course, after a year, either it's every month or every quarter, but over that year, that's when you would recognize your service revenue for the remaining $30,000. So that's the residual value approach. So in B, I didn't mean to put it up there so fast. I should have had better animation. It is what it is. So the market price for the service and the equipment are equally reliable, or this would be a situation where I have standalone pricing for both. So if I have standalone pricing for both, or if I have a reliable estimate of both, then I would use what's called the adjusted market assessment approach. And the way that we do that is we look at the fair value of both, or the standalone pricing of both, if we have standalone prices. And so the fair value of the equipment and the maintenance each is $438,000 and $30,000, which means the total fair value is $468,000. And again, if these were standalone prices, we would say the total standalone pricing is $468,000. And then what you do is you allocate proportionally. And so the proportion of the standalone or market value for the equipment is 438 out of 468. And then notice that we apply that to the actual sales price. So this denominator is from the total fair value or total standalone price. That's where the denominator comes from. But we're applying the proportion to the actual sales price. And so essentially what it does is this is inferring the discount on the equipment because it's being bundled with the service. And then we similarly do the same for the maintenance. Again, notice that the denominator is that fair value or the total fair value, total standalone pricing, if that's what we have. Again, applying it to the sales price for this transaction, and that gets us essentially what is a discounted price on the maintenance. So notice in the first example, the maintenance was not discounted, but the equipment kind of was. But of course, in that case, we assumed we really didn't have a reliable estimate for the equipment. So we don't really know if it was a discount or not. And so in this case, though, we do have a reliable estimate for both, or we have standalone pricing for both. And so we kind of infer that each one is being sold at a discount because they're being bundled together. Again, this is the method that you would use if standalone pricing is available for every item. Again, so if you could think about standalone pricing similarly to fair value, if you have both standalone prices or both fair values, this is the method you would use. If you only have one standalone price or one fair value, you would use the residual value approach. So the journal entries using that same accounts, nothing really has changed. So remember, we're not changing the journal entries. What we are doing is we're changing the allocation. And so in this case, again, the same 450, but now we're allocating 421 and some change to sales revenue and almost 29,000 to deferred revenue. And then of course that deferred revenue gets recognized over time. So, again, monthly, quarterly, but in this case, we're just kind of showing you at the end of the year, they would have done this. And then finally, let's say that neither is reliable, but instead the firm uses the cost plus margin approach. And of course, that means we're going to use the cost plus margin approach. It's the only one that's left. And so the way that we do this is we look at the estimated total cost. And so in this case, the cost of the equipment is 355. The estimated cost of the service is 20. And so we estimate a total cost of 375,000. And then what we do is we calculate a margin. In other words, if the sales price is 450, that means our margin is 20% over cost. So in other words, we take our cost, if we multiply it by 1.2, that's where we get 450,000. So there's basically a 20% markup on our cost for the total, right? So for the equipment and for the service. We really don't know if one is marked up more than the other. We really have no way of ascertaining that. And so we kind of, in this approach, we assume that both are equally marked up. And so then we think about the markup on the equipment or the margin on the equipment. If we mark it up 20%, really what we're inferring there is that, okay, the revenue for the equipment was 426,000. And then we do the same thing for the service based on the cost of the service. And we're estimating that the revenue related to the service was 24,000. Again, just a different approach based on the information that we have. And so again, same accounts, same amount for the cash. Of course, now the allocation is a little bit different, and that the sales revenue is getting 426, the deferred revenue is getting 24. We recognize that deferred revenue again over the 12 months or whatever, by the end, we would have recognized the full 24,000. And in each of these cases, we really don't know which one is right. It just depends on the information that you have. So if I have reliable estimates, or if I have standalone pricing for every single item, then I'm going to use that adjusted market assessment approach. If I have some, but not all, I'm going to apply that residual value approach. And then finally, if I don't really have any reliable standalone pricing or fair value, but I do have cost information, I'm going to use the cost plus margin approach when I allocate. Again, this is allocating one transaction price to multiple performance obligations. All right, so then now we're kind of getting to some nuances with step 5. In other words, when is a performance obligation actually satisfied? And so, not a ton here. This is probably real more conceptual than anything else, but we'll kind of walk through some. So licenses and franchises, with certain licenses and franchises, the length of the license sometimes can be specified. The length of the franchise agreement sometimes can be specified, but it does get a little bit complicated. And so I just want to walk through it. So again, licenses, that's a right to use a brand, right to use software or other intellectual property. So, there's licensing agreements when it comes to all these different things, like Adidas brand, Nike brand, whatever, with athletic teams, or somebody might want to produce clothing with the Nike swoosh on it. And so they have to get a licensing agreement in order to do that. Like Under Armour as an example. Sorry, wrong shoulder. Under Armour as an example. So how do you recognize revenue related to a license agreement? Well, it depends on the nature of the agreement and really depends on the seller's obligation. So if I'm Under Armour and I've licensed my brand to, in this case, I don't know who made this shirt, but some college, or this is high school, some high school clothing manufacturer. Well, it really depends on what the seller's obligation to the buyer is after the agreement is executed. And so if the seller of the license, let's say Under Armour, if they have no further obligations, in other words, there's you can use my symbol. Sorry, I keep going wrong shoulder. You can use my symbol, but I'm not doing anything after that. All right, then that's called functional intellectual property. And basically, as soon as the agreement is executed, you can recognize the fee. Like, you don't have to wait for anything. You've done your job. Like, okay, here you go. Here's the brand. Use it. You're done. your performance obligation at that point is satisfied. So when you have functional intellectual property, meaning there's no further obligation, Under Armour as the seller, they can recognize their revenue immediately. However, if they do have further obligations, let's say that I have to show up and promote it, or I have to agree to run so many ads, or I have to provide some signage, or I don't know, there's some other things that Under Armour has to do as part of the agreement, then that's called symbolic intellectual property. And so at that time, you'd have to recognize the fee over time as you continue to perform. And so again, the way you handle a licensing agreement greatly depends on whether you have an ongoing or further obligation. If there is no further obligation, recognize it immediately. If you do have further obligations, then you have to wait. Again, the first one's functional, the second one is symbolic. I hope by now, though, we've talked about this enough that you probably could have guessed it, but I wanted to be explicit here. Key concept, again, ongoing obligation, proportionally recognize it over time. By the way, franchise agreements are similar to licenses in that it just really depends on the agreement. It's likely, though, that with a franchise fee, you would recognize recognize a portion immediately and then some over time. It really depends, because if you think about a franchise agreement, like if I buy a McDonald's franchise or a Chick-fil-A franchise or something like that, there are some things that I get immediately. I get access to the brand. There are some things that I can do immediately. And so in that way, it's kind of like a functional intellectual property agreement when it comes to licenses. And so it's sort of somewhat functional, but there also may be a part of the agreement where, let's say, if I'm Chick-fil-A or McDonald's, you agree to run certain ads in my market for the next whatever number of years, and you agreed to provide updated signage, and you agree to all of a sudden now McDonald's or Chick-fil-A might have some additional obligations, and so they may have to kind of allocate some to an immediate recognition and some to a recognition over time. But again, I hope you've heard this enough where you're starting to understand, like, okay, I can start thinking through this and maybe even look at a situation and guess somewhat correctly on how they should recognize revenue. All right, so let's talk about bill and hold arrangements. Again, somewhat of a unique situation, but I think it's interesting. So a bill and hold arrangement is basically where a sale takes place, but the seller retains possession of the goods. So let's say the example that I like to use, and I don't remember if it comes out a little bit later, but the one I like to use is lumber yards. So a lot of times, especially if you've ever driven through South Carolina, there are a ton of lumber yards. But essentially what ends up happening in those situations a lot of time is a construction company will order some lumber. The lumber yard will cut the lumber, but then they'll hold it for the construction company. And they'll hold it until the construction company is ready for delivery, and then they'll deliver it, or they'll come pick it up. It just depends. Most of the time they're going to deliver it, but whatever is needed at that time. But they're going to cut the lumber usually, maybe earlier than that, to make sure that it's ready when the company actually needs it, because you cannot have a stock out when it comes to lumber. That's a bad day for a construction company. And so kind of as we walk through this, what does that look like? So here's the key. Even though the transfer of the good has not taken place, the seller might actually, the lumberyard in this case, may actually be able to recognize the revenue now, even though the transfer really hasn't taken place. But there are 4 specific criteria that must be met in order to do this. First, there must be a material or a substantive reason that there is a bill and hold arrangement. So you can't channel stuff. I think I talked about pharmaceutical companies sometimes will channel stuff to wholesale distributors. That's not what this is. There is a no kidding, really good reason that they're holding it. As an example, for the lumberyard, a lot of times the construction company might have to wait for a permit or an inspection of the foundation or something where, or weather or whatever, where they just can't take delivery. And so there's a legitimate reason that you haven't delivered the lumber. And so, in that case, it would seem that, okay, there could be a good reason the lumberyard continues to hold the lumber. And so, sort of that first criteria is probably met. And then the second one is you need to identify the item as belonging to the buyer. Very easy in a lumberyard. Put a tag on the lumber. Very simple. Or put it in a stall that's designated for Martin Martin Construction Company or whatever it might be. And so that's the second criteria. The third criteria, and again, all these must be met, by the way, not just one, all. The product currently must be ready for physical transfer. So for the lumber, maybe it's sitting on pallets, maybe it's wrapped, but either way, it's basically got to be ready to go out the door. And then finally, you cannot have the right or ability to sell the product to another buyer. So in other words, with that lumber, if I could take that lumber and I could sell it to another construction company and then quote unquote replace it, then I cannot recognize that revenue until it's actually been delivered. But if I am holding it and for a good reason, and it's ready, and I can't sell it to anybody else, then I may be able to, or then I can recognize the revenue now as a lumberyard rather than waiting until it's actually delivered. So again, that's a bill and hold arrangement. All right, disclosure. With RevRec, what do we disclose on the balance sheet? So first of all, obviously, we do disclose unearned revenue, which is, in this chapter, they call it a contract liability. It's similar to unearned revenue. So if there are things you're on the hook for where you've been paid, that is a contract liability. Again, if you have a payment, but you have some service in the future, you can have what's called a contract liability. Now, on the other side, this is the asset side. They really do. GAAP distinguishes between two types of receivables, or what you might call receivable. And it really depends on your rights. So there are what are called unconditional rights, which means you owe me, it doesn't matter what I do. And then there are conditional rights that could be in a contract, which says, okay, you owe me, but I know that I also have to do X, Y, Z in order for you to actually pay me. So there's sort of this, unconditional right, there is nothing left for me to do. And then there's conditional rights, which means there is something left for me to do under this contract, in the context of the contract. And in both cases, you may be able to recognize an asset. And so an unconditional right, usually there's a right to cash or something like that. But as soon as you have an unconditional right, no further obligation under the contract, that's a receivable. We've done that before. However, you could have a situation where you have a conditional right. And so in other words, some of the performance obligations have been met, or maybe a portion of this overarching performance obligation has been met, but not all of it. And so in that case, the firm records the value of the consideration as a contract asset. So as an example, whenever you have a performance obligation like build a house, obviously the performance obligation is build a house. Could you have completed some of building the house and be entitled to getting paid, but have some conditional rights on that? Like, okay, well, once you do X, Y, Z, then you can, like, maybe okay, we'll pay you when the foundation is done. We'll pay you this when there's lots of things you could imagine. But again, the key here is that you can still have an asset, even though the overarching performance obligation is not complete. All right, so we're going to stop there. And this is part 4. Part 5 is going to be going through a long-term construction contract. And so that one's going to be maybe a little bit lengthier, but there's a big problem on the test. And so we need to make sure we really pay attention to that one. But for now, that is part 4.